Hey guys, what's happening? Jay here. This is smarthelping.com. It's been a while since I did a full financial model with a three statement, financial statements and everything. This is in the car wash domain, and what we're going to talk about is scaling multiple washes over time. The car wash model in the past 6 or 7 years has been one of my top sellers, and I have had a lot of requests for doing one that allows you to scale multiple locations. Before I get into all the tabs, I'm going to do a quick run through so you can see. Well, before I get into detail, here's all the tabs: executive summary, ramping. This is where all the primary pattern assumptions are defined. CapEx is more of a detailed input. OpEx and unit economics here. Variable cost per car. Operating loans, cap table, startup cost, terminal value, income statement, balance sheet, cash flow statement, discounted cash flow analysis, bunch of visuals, KPIs, and then the monthly detail where it all comes together down into EBITDA and cash flow and annual detail. Okay, now let's actually get into it. I'll talk through everything. So you start out with the model on the global control tab. All of the cells in yellow with blue text are editable. Company name, it just shows up on the top of the financial statements, so you put anything, whatever there. Forecast period length, how long you want the model to go for. It could be 60 months, 72 months, 84, 36, whatever you want. And every month after this month defined will zero out. For example, if I put 84, you can go to the executive summary. Now you can see it goes only to 7 years. And there's your exit dynamic happening. Put it back to 120. There's quite a bit of logic going on here, but your alternative would be to do it on paper, which would be insane. There's so many variables, so you'll have to wait a couple seconds when you change some of the inputs. Just because there's a lot of logic happening behind this model, which we'll go through. You could include a terminal value or not. Usually that'll just be a yes, and then whatever EBITDA multiple you think you'll get. There's the exit value, first forecast month. This is just a reference input. Nothing's tied to it as far as calculations go. It's just for displaying across the top here. And you could put any month. It doesn't matter. It doesn't need to be, it could be 6 year. No problem. It's not going to mess up any of the balance sheets calculations or anything else. Um, Cash sources, investor equity are just summaries from other tabs. Owner equity, we'll put that in on the cap table. And then you've got some taxes and useful life for depreciation, which is just going to apply blanketly, as a blanket amount to all the capex items. All right, executive summary is your high level. We'll kind of come back to this first. Let's dive into the ramping tab because this is where everything's actually happens. So you can scale two different types of car washes, and you could do just one type or both. And so the first one is new developments, and that means you're getting a construction loan possibly. It's taking longer till you have revenue. The construction loan can convert to a permanent loan. You've got non-member and member revenues, um, and you can see here as I change this, it takes a second, but there's a lot of logic tied to these inputs here. So if I zero all these out, one new development, and we zero this out, this will be good for explanation purposes. It's always good in a complex model like this to just start with a one and just see it, and then you can start planning out new, scaling. One thing this model is really good at is it'll tell you how much equity you need at minimum based on your scaling assumptions and the minimum cash position. And this is good at showing, okay, if you start with one, you build operational profits. Let's go to monthly detail. Here you start to get even bit of positive and build cash, build cash, build cash. Well, in this case, we are only one is not doing a whole lot for us with the debt service. But the idea is you can adjust the assumptions, and as you're profitable, you could scale up, and then once you get to a certain cash flow amount, you can scale a second one and a third one, and so forth. And the faster you scale, um, the more money you'll make, but the more money you might need as well. Uh, so there's a balance there that you can strategize with. But anyway, so one new development, let's say we're doing. Um, so here's the capex 1,140,000. You can go over here and see where that's coming from. Well, we do capex 1, capex 2, capex 1 for new developments. So here's all your site work permits, just all the construction costs. You define the total amount here in column C, and then you define the percentage of that amount that's paid over the tenure of the construction period. So this month 1 through 30 applies dynamically whenever you get a new development starting. It starts, month 1 of whatever start month that is this percentage of this cost gets paid, and so forth. So if I were to start this new development in, say, month 3, you'll see the cost, the capex is still 1,140,000. But if we look at the monthly, those costs are happening now from month 3 to 12 rather than month 1 to whatever would have been, I think, 10. So that's dynamic. Then these are other non-finance costs, what have you. Could be closing costs or just any cost that you want to define that's not subject to the construction loan. These are all subject to the construction loan draws. Um, these are not, so these just hit cash flow and whatever months based on the percentages defined. The percentages of each row should add up to 100%. Here's the term. So for the construction loan, if our cost is our total cost is 840, that's subject to financing. We're saying 65% of that's borrowed. So loan, that's 546,000 there, and that should be, if you divide this by that, it should be 840, which is this amount here. So that's what we're borrowing. We've got debt service based on interest only period, which could be any amount of months, and interest rate. And then after that interest only period, it'll convert to a permanent loan with principal and interest payments over some term. Interest rate here. The permanent loan will be paid back either at the exit or at the end of the term, depending on if the term is less than the end of the forecast period. um, the the acquisition side for debt only has a permanent loan because the idea is you're just purchasing a new location. It's ready, operational. It might take maybe a month or two if you're doing renovations, but basically it's ready to go. So you're starting to pay back that loan immediately on a regular schedule. But for the new developments, you've got a layer there. And one thing you want to make sure is the interest only period should be well, your capex shouldn't go further than the interest only period. So right now this being 10%, we're going all the way to month 10. Interest only period should be at least as long as the last finance development. So this should be maybe 11, because you don't want to switch to a perm loan while you're still drawing on these construction costs. That's not logical here. So and remember, all this is dynamic for every time you put a new location in here. If you put 2, it scales up, so this would be double everything. So that's the loan debt financing assumptions. We have revenue assumptions up next, so you can define the start month of revenue, your starting monthly car count for non-members, the monthly growth of that, and then the stabilized car count monthly. So it's not super granular, but it's also granular enough to get a nice scale out to show just, okay, we'll start at some amount, we'll grow to another amount, and then those car counts, every time they come through, we did a weighted average price per wash here of 13 bucks. Now, this will be different for every location, or not every location, every different operation. So you got to figure out what numbers make sense for your strategy. And then the better you, or the more work you put into um, the more work you put into your inputs, the more valuable the model will be to you. Um, just gonna scale out a couple more of these so we get an IR for the investor here. Um, so the yeah, that I mean, you kind of get into it what you get out of it what you put into it. And annual price growth of that cost. Then for membership revenues, you have a start month, um, which could be different than non-member revenue, and the starting member count. So these are recurring. This is a recurring revenue portion. The monthly growth of your members, stabilized member count. Because at some point you can't just add members forever uh, for a location, because you will at some point have a capacity problem. So it's not realistic to just scale it forever. So you should have some stabilized amount that you get up to, then it stops, and we'll define the washes per member per month. This is important for costs. So here we're saying actually um, a member only uses the car wash once every 2 months at zero point 0.5. Now that number is going to take some research, but it is very important to understand for capacity purposes. Average membership price, so this is what they're paying every single month, and then the annual price growth of that. Down here's just an example to show you. You could put in a member count and how many actual monthly washes those members um, use up, and then this here, this output would be what you put into this input, washes per member per month. So this is just a little helper calculation, and then we did some more, like this is showing how many minutes are available per wash based on the washes per day and washes per hour against the operating days and hours open per day. And then here we combine both members and one times to show what the stabilized minutes available is if you were fully if you were using these assumptions here. So 7.8 minutes per wash, it might be a little aggressive. But again, these numbers are just arbitrary. You can plug in your own. For the acquisition, so the car washes you're just buying that are already operational. Again, we said there's just a regular perm loan, no interest only period. You've got non-member revenues, same assumptions as the new development. But again, your revenue start month is likely going to be a lot sooner than the non-member or the revenue for developments, because there's this development period where you're actually building it out. So you shouldn't have a start month here that is earlier than the end of the construction. So we put this at 11. And we started, remember, in month 3, so we're actually not going to have revenue till year 2 in this case. Now if I add an acquisition here, you can see our capex goes up a bit. We scale up a little bit more revenue. Debt service coverage is a really important one if you're using any of these assumptions up here, because you want to know how much operational cash flow you have to cover cover your debt service. And then there's a lot of unit economics down here showing the total car count per year, average revenue per location, average revenue per car, which you want to make sure. So your average revenue per car, average variable cost, and fixed cost per car. This is showing you your profitability on a per car basis. Then you've got capacity here. So you can see we get down to 7.8, which is the same as this, and that's because this is your stabilized. So after month 25, we're not adding any more locations. So the capacity won't change after that for how much is available once you stabilize again, and that'll depend on how your growth percentages are, what your stabilized car count is compared to the starting amount, and all of those different assumptions. I thought it was really good to have this financial summary here so you can change these primary assumptions and see what happens. That's useful. CapEx tabs 1 and 2, we already went through 1. This is just your costs every time you start a new location. For CapEx 2, these are acquisitions, so you've got initial upfront costs that happen all immediately in month 1. You might have some other costs that are not financed or subject to financing that happen over time. Maybe in the first few months, these you could enter here. It could be closing costs or just maybe renovations that you're not getting financed or something else. But it's just giving you the flexibility to have finance costs and non-finance costs happening for new location acquisitions. M1 and M2 tab, this is where all the dynamic logic is happening. If you want to follow through that, you can. OPEX tab, we have corporate overheads, which is just your sales and marketing, G&A. One second here. These are just a way to define fixed overheads. So you've got these are all annualized costs. In each section, you've got where you can enter the initial amount and then a growth rate on that, or you can just define it manually. And remember to put in the start month here. But down below, you also have costs as a function of total monthly revenue for like credit card fees and those things, or any other items you want to catch there. And then this is important here, the fixed ongoing cost per location. So fixed ongoing cost per location, your labor, your non-variable utilities, just anything to keep the locations running besides your obviously variable costs per car, like electricity, water, chemicals. So this is annual amounts, and then you've got an annualized growth rate. Variable cost per car, so every time a car comes through, you figure out how much you're spending in chemicals, water, sewer, electricity, or energy, supplies, waste handling tied to volume, or maybe claims breakage fund, reserve, and then so those are the initial amounts, and then they might go up over time, which you can account for here. And all that flows through. All that flows through to the monthly pro forma. Loans 2 and 3 tabs are just for operating loans. They're just a standard P&I loan. If you have a loan amount, define the month that happens, and you just have standard repayments. This is more for operational activities, not tied directly to the location counts like these loans are. Cap table. Here's really simple. The model solves for the minimum cash you need. In this case, it's 29 million. The first top section is how much money you're getting from investors. The bottom section is how much money the operators owners are bringing in. These totals, if you add up all of these boxes plus these, should always equal this total here. And I put a filler in the overflow, which just has whatever hasn't been assigned to anything. Like, so here's 29 million. We've only put 2 million into founders, so the rest just goes to overflow for investors. So that's the first row column you need, right? Second column is just the percentage of equity. Here we're just saying a 50-50 split. but the total should add up to 100% when you add up the top and the bottom together. There's preferred class A and B. If you need to do that, you can, and it'll just adjust the total percentages over here for how cash is distributed. Um, Usually, this is the default scenario: 100% into common shares. Share count, what is arbitrary, but you want to make sure your investments here make sense and the percentages here um, all make sense. And you can see distributions for each row here and contributions as well as IRR. Okay, startup costs. These are just another place to put in one-time fees, maybe consulting fees or just things that hit right at the beginning that you're not accounting for anywhere else. Terminal value is actually a little bit more important than it might have been in other models. So here you have to enter the sale value of real estate because you can see here. Now this is assuming if you're renting, then it doesn't matter. If you're renting, then you wouldn't have, these capex costs and all the debt. But if you're purchasing or acquiring and you're owning the buildings over time, then this EBITDA multiple for the exit is going to apply to the business, but you also own the property. So you got to assign a value to that at exit. Here, it's just a hard-coded input of 35 million. Now to help you, I did put in the cost basis of all the capex. So 55 million here is your cost basis. Now this is the book value after accounting for all depreciation up through the end of the forecast period, whatever that might be. And then the profit or loss here will flow through to the financial statements. Now obviously if we spent 55 million and then we sold it in 10 years, we probably would sell it for more than 55 million for all the locations, maybe 85 million. So you want to make sure to adjust this number. It is important to the model. Income statement. So here we have one-time revenues, membership revenues, all our variable costs, gross profit, fixed location-based expenses, corporate overhead, startup costs, EBITDA, four-wall EBITDA, interest, depreciation, extraordinary income, sale, business net gain or loss. We're just assuming here that startup costs are just going to be something that's expensable or tax deductible. Net taxable income taxes, and net income. If you go to the end, you can see here's our exit proceeds and relevant taxes for those, and after-tax net income. So it's pretty comprehensive here. Income statement, annual, same deal, but an annual basis. Balance sheet, balances all the way through, shows you how much cash you have, fixed assets, how much you spent on capex, accumulated depreciation, total liabilities, investment proceeds, retained earnings, owner's equity, and then these balance out. And here's your check there. Cash flow statement is nice to see. It's almost like a sources and uses, so you can see what is going on with the cash flow in each period. You got operational activities up top, investing activities, and then financing activities here. And you can see what that looks like over time. Discounted cash flow analysis is just going to feed off that cap table based on the percentages going to the investor versus owner, and then their initial contribution amounts. And then this is the project cash flows. Again, the model solves for minimum equity needed. In this case, it's 29 million, and that covers all the cash requirements for, in this case, it's the first few years. So there's no available cash distributions in that period because you're just funding the scale up. Then we do have some positive cash flows here, and then the exit. This is a very simple view of like an investment waterfall. I've got way more complex things, preferred equity, IRR hurdles, all sorts of distribution models separately. I do consulting work in that regard, so if you want something more in depth, I can plug that in. But for this, it is just a super high level, cash in and out of the project, and then just straight up percentages for the investors and owners. Visualizations, we got revenue, gross profit, EBITDA per year, cash flow, um, gross margins, annual capex spend. This one's pretty important. Monthly cumulative cash flow. You can see here you're ramping up. You stabilized. Now you're making money. You're starting to pay that back. We actually pay back the whole project cost by year one or month 102 with its own operations, and then we're positive here. Then the exit value. Um, Unit economics. So we see revenue, cost, and earnings per car. Average monthly revenue per location. Average wash count per location per month, total locations. So these are helpful to kind of explain your business strategy or a business plan with visuals instead of just seeing numbers. Uh, Total locations acquired versus new developments. Total members over time. Member versus non-member revenue. Member versus non-member revenue per month. Oh, sorry, this is member versus non-member wash count. And then this is revenue, member versus non-member. And then your debt service coverage. Then we have monthly detail. This is where you can kind of go and see as you're putting in all those assumptions. This is where they display in a pro forma style. So you can see locations over time for the new developments versus acquisitions. Car counts, revenue for each of the different cohorts, which is just new developments, non-member and member, and new acquisitions, non-member and member. Variable costs, gross profit, the fixed cost per location. So on this, if you go to the OPEX, the total column we're just taking, so this is the actual row we're referencing, and we're just applying that. Again, this is our annual figure, so we're dividing by 12, but we're just taking whatever that is in the given year against the total location count. Now if you go to, so if we went to 1347, this is just doing as long as the cost, so and those fixed costs start when revenue starts, depending on and it's when non-member revenue starts for acquisitions and development. So this is 2, so we have an acquisition happening in month 1. The fixed costs and revenues will start in month 2. You see here there's car counts. This is part of revenue. Now if we go to M1, fixed cost per location, that's taking, those fixed costs aren't hitting until month 13, because here we're starting in month 3. There's 11 months until revenue begins, so we're not starting those fixed costs until we're operational. And then they just follow whatever is on the fixed costs. And then this is obviously also multiplying by the location count for each cohort. So that's fixed costs per location. Then you've got all your operating overheads, corporate. Four-wall EBITDA is just the amount of EBITDA from the location specific, not counting these corporate overheads. And then EBITDA here is counting the corporate overheads. Loan proceeds, principal, repayments, interest expense, then consolidated debt service coverage, and then other cash flow items. We've got capex, taxes, exit proceeds, and loan repayments. These are on the exit or on the end of the term. And then cash flow, and then key stats. And that brings you to the end of the model. Now, a lot of people will probably focus on the monthly detail the most when they're adjusting things, and to see how this cash flow evolves over time. It's probably one of the most important rows of the whole model right here, and the cumulative cash position, because it's going to tell you how much money you need and when, based on all the different assumptions here. You can minimize these rows, hitting the little 1 and 2, so you can see more of the high level rows without having to scroll down too much. The annual detail is the same exact thing. It's monthly, but on an annual view. We've got a lot of sanity checks in the model to make sure all the statements match up. The balance sheet balances and the cash flow from the monthly detail matches the cash flow on the cash flow statement. So these are all the checks on the global control that you see here for that. Executive summary is kind of like, it's just a high level view, not too detailed. So you got revenues, variable costs, gross profit, fixed costs, EBITDA. You kind of see everything all in one quick view, cash flow. And then you've got project IRR, equity required, equity multiple, and then you got the same thing for investors and owner operators. IRR, equity required, total cash return, equity multiple, and total return on investment. And a couple of visuals here. And that's the model. So to me, it's a nice balance between granularity and detail and not and high level. Back of the envelope, so you can kind of get an idea how fast you're going to scale. What does that look like on average per location? What's your total cost going to be? What's the returns look like on that? How big are you getting? How much debt are you going to have? All those things you can kind of plan out with this pretty quickly. What will take time is researching what your assumptions are, and what you're trying to target. So this is like you're setting up your target ideal location stats, what you want to have, and you want to be conservative about it so that when you go and actually do it, you have buffers and there's room for variance and negative variance to happen. But this is very useful to see what makes sense, and what assumptions are viable and what are not. Now, if you want to download this template, it will be available. Let me pull up the site really quick. So if we go over to smarthelping.com, this model will be in the general industry section under automotive. We already have a couple other models in here: EV charging, auto repair, car wash. I actually need to add, we also have on-demand car cleaning service. I'm going to add to this automotive bundle. And this is like a sub bundle because you can get the industry specific. It includes all these things, but if you just want the automotive, um, that's here, which I'll add in. So the car wash multiple location scaling is going to be what I'll add to this, plus the on-demand car cleaning service, and I think that's all the ones I want to add to it for now. So you could buy that. You can browse all kinds of templates. You can also hire me for $275 an hour. Um, and this is updated here. There's now a buy now, pay later option if you do PayPal for installment payments, which is useful. But I'm pretty quick with the turnarounds and have availability. So let me know if you want custom work done, and you could also check out more financial models on the financial models tab. I've done these kind of templates for hundreds of different industries, a lot of different recurring revenue models, real estate, joint venture, waterfalls, all sorts of tools here. So if you're new to spreadsheets, this is a great place to be. If you're not new to spreadsheets and want to know, just want to understand business like the underlying drivers of revenues and expenses for different businesses and run different cases, this is a dream place to be for you. So check it out. Like and subscribe, and I'll see you guys on the next one.